Good morning. I'm Josh Lipsky, the Senior Director of the Atlantic Council Geoeconomic Center, and welcome to our first event of 2023 in what has become somewhat of a staple for us and an annual tradition here at the Atlantic Council. We start the year with the global economic outlook. Now, we have done this for the past 3 years. In 2021, we discussed the economic fallout from the pandemic. In 2022, we discussed supply chains and how long-lasting and sticky inflation would be. I think we had an answer to that question over the course of the year. But in 2023, I would argue we have the widest array of possible outcomes we have had in recent years when it comes to the global economy. Will the US enter recession or not? Will the Eurozone weather the energy storm and war in Ukraine? Will China rebound? A few weeks ago, we were talking about stagnating growth in China, and now we're thinking maybe 3, 4, 5%. Is that possible in China this year? These are the issues we are going to cover. And to do it well, it requires data-driven analysis, thorough research, and nuanced thinking. And we have absolutely two of the best in the business to help us do it. Jan Hatzius, Chief Economist of Goldman Sachs, and Megan Greene, Chief Economist, Kroll Institute, Senior Fellow at Brown. Thank you, Jan, Megan, for joining us again this year.
Great to be here.
Jan, I'm just going to jump in and start with you. We have a lot to get to. We're going to have audience questions as well that we'll get to in the second half, so please submit questions. But let's start with the US. I think Goldman's forecast is above consensus. You're more optimistic on the US outlook than most others right now, predicting that the US can avoid a recession, and I think a soft landing is possible for your forecast. So if you can take us inside the thinking.
Sure, thanks so much, and great to be doing this again. We do have an above consensus forecast, a little over 1% growth, below trend, but nevertheless positive. You can also look at this through recession risk. The median probability of forecasters in the Bloomberg or Wall Street Journal survey currently is about 65% that the economy will experience a recession in the next 12 months. We put that number at about 35%, which is not low. It's definitely 2 or 3 times the normal probability in any given year, but obviously lower than the consensus. Why is that? I would say there are 2 reasons to think that the economy will continue to expand in the next 12 months. One, real disposable personal income is looking a lot better than it did a year ago. A year ago, we saw the biggest decline in real disposable income in post-war history, basically because of fiscal normalization and the inflation surge. Now, the fiscal drag is in the rearview mirror. The adjustments taken place, and inflation, headline inflation specifically, which is what matters here, has come down very substantially. So real disposable income has been growing the last several months, and we expect it to grow at 3% plus over the next year. Second reason for a somewhat optimistic view, more optimistic than consensus view, and this is, I think, a large part of the debate, is that we think the biggest drag from monetary tightening and from tighter financial conditions is occurring right around now. The biggest tightening in financial conditions, the most rapid deterioration, if you will, really occurred in the first half of 2022 as the Fed moved from no rate hikes or very limited rate hikes to 75 basis point rate hikes. And we estimate that the lag is about 2 quarters, so really late 2023, maybe late 2022, maybe early 2023 is the peak. And then as we go forward through the year, as financial conditions have been somewhat more stable in the second half of the year, we also would expect that drag to abate. So that's effectively the case for why things, why there's not this sort of big negative that has yet to occur from the lagged effects of monetary tightening. That's our forecast. Now, the real question is probably, how can we really bring down inflation from these extremely high rates? And, I should say, of course, inflation was much higher in 2022 than I expected, much higher than the Fed expected. We got up to over 9% in terms of headline CPI. It's now down to a little over 7%, but we're still far above the 2% inflation target that the Fed has in PCE terms. So how can we get this inflation under control without a recession? Doesn't that fly in the face of what we've seen in past high inflation episodes like the 1970s? I think there are some very big differences between the environment we're in now and what we saw in past high inflation episodes, especially the 70s, that are going to make it much easier to bring inflation down with much less weakness in economic activity. Number one, inflation expectations are extremely well anchored. They were long-term inflation expectations were close to 10% in 1979. They're now at 3% if you look at University of Michigan, and that is actually consistent probably with something closer to 2 if you look at history, because those estimates typically overstate somewhat. Number two, there are some very important freebies on disinflation sources that do not require a large amount of weakness in activity. One is normalizing supply chains. Supply chains have normalized to a significant degree. Only some of that has shown up in the CPI and PCE index so far. We're still going to get some benefit from that. And then number two, the big rent surge, which is still very visible in the CPI, we think is already basically behind us if you look at timelier indicators. So as we go through 2023, rent inflation in the CPI, in the PCE index, likely to come down very substantially. And then the last big difference with past cycles, and I think one reason why I think we'll be able to unwind this inflation more quickly is that while the labor market is overheated, the overheating manifests in a very high level of job openings rather than an employment level or unemployment rate that is overheated. I don't think we're employing too many people to be sustainable. The unemployment rate is where it was prior to COVID. The employment to population ratio is lower than it was prior to COVID. And what we do need to do is, continue to bring down job openings. The economy needs to grow below trend. Firms need to continue to bring down job openings. And I think that is going to then also result in a slowdown in nominal wage growth to more sustainable levels. I think that slowdown is underway, but there's still quite a ways to go. So that's sort of my case in a nutshell, why I think there will be some support for growth over the next 12 months, and why, maybe more importantly, we can bring down inflation without a large amount of weakness and inactivity.
Okay, Jan, thanks. That was an excellent overview of the case and the thinking behind the GS forecast there. At some point, we're going to have to follow up on the long and variable lags of monetary policy you talked about, and whether Milton Friedman, as you've written about, maybe that quote's a little misinterpreted. So we'll get to that. But Megan, I want to turn to you because what Jan is saying would be out of the historical norm. It is rare for the Fed to be able to engineer a soft landing. If you look back at the last 30, 40 years, probably it's happened only once. Is it really possible, or what is your forecast, that we'd be able to maintain 3.5% unemployment, get inflation down to under 4, 3%, and avoid a recession?
Yeah, thanks. And thanks again for having me. I have a different view on the outlook for the US this year. I think it's going to be incredibly difficult for the US to avoid a recession in the second half of this year. This kind of immaculate disinflation that Jan describes isn't impossible. I just don't think it's very likely, in part because of the historical precedent that you referenced, Josh. The Fed, on the one hand, and Larry Summers and Olivier Blanchard, on the other hand, have had this debate about the labor market and about whether we could just whittle down job openings and not see a deterioration in the labor market. The Fed's argued that it's possible, and I think that's a nice theory that just doesn't play out ever, actually, in real life. As Larry and Olivier have pointed out, there's just no data suggesting that that's happened before. I think what we're seeing so far, and particularly in the last jobs report, is that the labor market really has held up much more strongly than I expected. But I also expect that a piece of that is labor hoarding. And so as companies have had difficulty finding workers, and as growth has slowed significantly over the past year, I think companies are hoping they can hang on to those workers, make it through this patch to the other side, rather than laying them off, having to find them again, retrain them. It was so hard to find them in the first place. But at some point, I do think that there will be a capitulation and that companies will end up stopping hoarding labor, and we'll see a deterioration in the labor market then. So I think one question is, will the labor market deteriorate? I expect it probably will. And by the way, a jump in unemployment by a certain amount is the best indicator of a recession that we have, better than any economist, better than any yield curve or part of the yield curve. So I think that will portend a recession. I also think we need to look at financial conditions. So Jan highlighted that financial conditions have tightened. They've actually loosened more recently, and that's partly because the markets aren't buying what the Fed is peddling. The markets have 2 rate cuts priced in for this year, whereas the Fed has said they'll get rates up to above 5% or above, and then they'll hold them there for the rest of the year. And I think the markets are mispricing the Fed. And so if I'm right, and the Fed is going to keep rates high for the remainder of this year, even as the labor market deteriorates and we go into recession, then the markets are going to have to reprice that, and you'll see a tightening in financial conditions as well, which will exacerbate any kind of downturn. I agree with Jan that inflation will come down over the course of this year. Peak inflation we probably saw towards the end of last year. But I don't think it will be anywhere near the Fed's target by the end of this year. I think one thing that the Fed learned from the 1970s, 80s experience was that stop-start monetary policy isn't very effective and means you end up having to hike rates even more ultimately to lean against inflation. And they're really keen not to do that. So I think that the Fed, when they say that they'll hike rates and keep them up there, I think they will do that even in the face of a downturn and a deterioration in the labor market. One of the reasons I think growth has held up so well thus far is that there's a massive cash cushion across the economy, thanks to the pandemic response that we had in 2020, 2021. And so households in aggregate are sitting on a lot of cash, and consumption, of course, accounts for about 70% of US GDP. But we're starting to see signs that households and corporates actually are seeing a bit of stress. So delinquencies for both households and corporates are rising. Credit card balances for households rose 15% in the third quarter of this year. So while in aggregate there's a huge cash cushion, some households are clearly getting into trouble and putting purchases on their credit cards. The personal savings rate has dropped significantly. And so I think these are all signs that we're starting to whittle through that cash cushion. And as rates continue to rise, less aggressively now than before, but we've seen 425 basis points of hikes since March of last year. That's a lot. As corporate earnings start to fall, I think we'll end up seeing more companies get into trouble, more households get into trouble, and also once the labor market deteriorates, once people hear about layoffs or experience them themselves, then they'll really retrench. And that's when we'll go into a recession in the second half of this year. I expect it will be a short and shallow recession. That's the good news. There is a risk that we'll end up with a financial crisis on top of a recession. There's a lot in the shadow banking sector that we just don't have great visibility on. As we're withdrawing liquidity globally, you could see pockets of dislocation in the markets that hopefully the Fed can step in and paper over. So it's not my base case that we'll have a financial crisis on top of a recession. If we did, it would be a longer, deeper recession, but I expect it will probably just be short and shallow.
Megan, thank you. And what you just said reminded me of what Chair Powell said at the December meeting when asked about this. He said, we don't know if there will be a recession or not. And if there is one, we don't know if it'll be mild or not. And that honest answer struck me from him. And I think both of your answers are getting into what we talked about at the beginning, the range of possibilities. Jan, I want to come back to you briefly on the US before we move to Europe. We're getting a lot of questions in, and others please submit using the Q&A function. But on the possibility of breaching the debt limit, this has got a lot of attention now in the US in the past week, given the Republicans control the House. Is this something you're factoring in yet to your forecast, or is it a wait and see approach at this point?
Certainly not in the base case, but I mean, our strongly held base case is that eventually we will, avert a crisis, but it could be, a relatively close call. And we have said that this is likely to be the most disruptive episode since 2011, and 1995 was another very disruptive one. So clearly there is a lot of room for disruption. Maybe just one, not to belabor the kind of recession view, but on the Fed, my base case is similar, I think, to Megan's and similar to the dot plot, that they go to 5 or a little bit more, 5 to 5.25. I do think they're probably going to slow down to 25 basis points in February, but then we do have another couple of hikes. We don't have cuts through the end of the year, but that is very much dependent on the economic outlook. I think if there was a recession, I have no doubt that they would cut, and probably cut quite a lot. Certainly given my inflation outlook, which is already for very substantial disinflation to the 2.5% range by 2024. If you put a recession on top of it, more substantial deterioration in the labor market than the roughly half or 3/4 of a percentage point increase in the unemployment rate that we have in our base case, I think they would cut.
So your call in 2024, is it early 2024, mid 2024? We're sub 3% inflation at that point. Is that right?
Right. Yeah, we have 3% for basically all the major indices by the end of this year. So we're looking for some convergence between CPI and PCE for a variety of technical reasons, and then have all of these numbers go down to somewhere in the 2.5% range.
Got it. Okay. Thank you. So for those like us on this call who are interested in monetary policy, the Atlantic Council today is releasing our new monetary policy hub. You can find it in the link here. This tracks all global monetary policy events, shows inflation, QE, QT, everything happening at G20 central banks. So it's a great place to do a deep dive. We'll share the link and we welcome feedback on it. Megan, I want to go to Europe. You're in Europe. A few weeks ago, we were thinking about Eurozone, talking about recession. It seems to be the sort of vibe here about Europe is that the storm may have been weathered from an energy perspective over the winter, and the outlook is a little more optimistic than it was a month ago. Is that how you see it?
Yeah, I think that's absolutely right. Of course, it's all dependent on the weather. And I think the only forecasts that are more unreliable than economic forecasts are weather forecasts. So I would hesitate to extrapolate the mild weather that we've had in Europe so far this winter into the rest of this winter. So there is a risk there, but generally energy prices have come down really significantly. The China reopening should benefit export-oriented Eurozone economies, particularly Germany, which happens to be exposed to China. I will highlight that China's opening, and I'm sure we'll get to that shortly, but it will mainly boost consumption in China rather than investment. And so the spillover in terms of commodities and inflation will be more muted than it has been in the past. So it will help Europe, but probably less than it has in the past. And the question always has been not so much about this winter, given that Europe managed to fill their storage pretty fully going into this winter, but it's also a question about next winter when Europe can't rely on Russian energy at all. The forecast now suggests that storage should still be 50% full by the end of this winter. Again, that's predicated on weather forecasts, so there's high uncertainty around that. But if that's the case, then European countries won't have to refill storage as much. So that's positives. So overall, that plus the fact that data has surprised on the upside, going through the first few months of Q4, have caused many to revise their European outlooks upwards, myself included. There is a question about whether Europe can dodge a recession or not. I think, Germany and Italy could well already be in contraction. It's a question for most Europeans. It doesn't matter whether they're growing by 0.5% or contracting by 0.2%. It feels the same to them. So it's a bit of an academic debate. For what it's worth, I think Europe probably will go into recession, but it will be shorter and shallower than previously expected. In Germany, industrial production, PMI data, retail sales have all been weakening. It's the same for the other big European economies. And so I think that suggests that drag could cause a contraction already in Q4 for some of the major economies. So I expect Europe will go into recession. The outlook looks better than it did just a couple of weeks ago, though. In terms of inflation, really quickly, inflation, the last data print surprised on the downside. So inflation came down more strongly. Headline inflation did. I'll highlight that it's still just under 10%. So it's still incredibly high. Energy costs have come down a lot. They're still pretty high. So there is a cost of living crisis in Europe. It looks less grim than it did a few weeks ago. But I do think a lot of Europeans are feeling the pinch from that.
And Jan, is that how you see it as well? I mean, Megan makes a good point, whether it's 0.2% growth or 0.5% contraction, not a huge difference in terms of day-to-day life. But Goldman did revise the forecast. I think yesterday I saw the headline in terms of the Eurozone outlook. Are you seeing this slightly more positive trend? And how do you see divisions within the Eurozone? Megan talked about Germany and Italy. Where are the strong points in the Eurozone from your perspective?
We did make an upward revision. We had a recession forecast previously. We no longer do. We're still expecting, fourth quarter, maybe slightly negative, but not enough to make it a recession. And there are basically three reasons for the shift in view. Number one, just the resilience that we've seen in the hard economic data. The soft data, the surveys, were very weak. They've bounced a little bit more recently, but they were very weak for much of this year. But industrial production actually has continued to go sideways in the euro area as a whole, and pretty much even in Germany. There are some areas, the energy intensive sectors, that have gone down, but then other sectors like the auto industry have recovered. And it's been remarkably resilient given the substantial cutbacks in primary energy use that we've seen in Europe. So that's observation one. Observation two is, again, the warm weather, the big drop in gas prices, and the fact that, as gas prices at the retail level ultimately will also see some relief, real disposable household income in the euro area, which has also been very weak, in part because of these very high utility bills, is likely to recover. That's going to help in 2023. And then lastly, a boost from China, I think, is going to be visible, especially in the export-oriented economies like Germany. So putting those things together, we've gone from mild recession to mild expansion. And I think also the differences across the different euro area countries are probably smaller. If Germany gets some relief on energy, and also if there is a benefit from reopening in China, so we no longer have these large gaps. One area where we still do have a gap is the UK. In the UK, we still have a recession forecast. We made some upward revisions there as well, but not enough to forestall a recession there. So they're definitely the laggard in our forecast.
Jan, you read my mind about the UK. That's where I wanted to go next, because a different scenario than Europe, given everything we've seen play out, weakest of the G7 right now. Where are you on the UK in terms of a contraction in 2023? And I saw an interesting story, if you can comment on this, that the Russia forecast from GS in 2023 is not so different from the UK forecast in terms of GDP growth. Is that still how you see it?
Well, it is weaker, but yes, we do have a recession in the UK. It's not a very deep recession, and in Russia, I mean, obviously numbers you have to take with a significant grain of salt, but it does seem that the pace of contraction is relatively muted as well. The UK is really suffering from, I would say, some of the worst of both the US and the European issues. Europe, the energy crunch and the natural gas crunch. The UK is obviously part of that market. So that's still a drag, though less so than previously. And then the US side of it is an overheated labor market, wage growth at unsustainable levels. In fact, when we look at our wage tracker, which aggregates a bunch of different signals on nominal wage growth, the UK is actually somewhat faster now than the US, where we're estimating something close to 6%. And that's quite far above what you can combine or what you can have, what could be consistent with 2% inflation, of course.
And Megan, do you agree on the UK? And should we expect any more shocks in the UK like we saw in 2022, or is that behind us?
Yeah, so I think the UK is already in recession. I think the Bank of England has actually suggested as much itself. I think the Bank of England will continue to hike as well, not as aggressively as the ECB, for example. But there's also a massive mortgage reset in the UK that will drag pretty significantly on consumption. So I think that will exacerbate the recession. Might we get more crises like the LDI blow up? It's possible. I think the Bank of England has shown that it's willing to engage in QE to restore market functioning, even while it's tightening policy. There's a precedent for that. I think the Bank of England won't be the only central bank that will have to do that. But I think the Bank of England can probably paper over those pockets of dislocation. I just wanted to mention really quickly an upside and downside risk for the Eurozone. Uniquely, on the upside, we'll watch the absorption of RRF funds over the course of this year. It's been really difficult to figure out what exactly is being done with those funds, how they're being absorbed, how effectively they're being used. Of course, there's been a lot of inflation since countries applied for those funds from the Next Gen EU. And so it's not clear how far those funds are going to go now. But we'll need to watch that because that could present an upside risk if companies or countries, particularly peripheral countries, can absorb those effectively. On the downside, of course, is the risk of fragmentation, as the ECB came out very hawkishly in December. I think there will be a number of rate cuts over the course of this year from the ECB, even in the face of a downturn. And at the same time, the ECB's announced QT. So a country like Italy with a massive debt burden that's benefited from reinvestment from the PEP could face pressures as a result of QT and tightening rates as well. So it's just worth pointing out.
Yeah, no, I think the fragmentation risk is something we're paying very close attention to at the council. And that's why we did the monetary policy hub, is specifically to look at how that's going to reveal itself over the course of 23. I think the ECB, just my take, has a harder job than the Fed right now in managing this. That can be true often given what they have to manage, but especially this year. I want to turn to China, since we have already about 50 questions in the chat about it. Not that I wasn't going to ask about China no matter what. Jan, GS forecasts in general have been more bearish on China than the consensus. And I wonder how the end of zero COVID has shifted the way you think about it. Even 2 months ago, we at the council and many others were talking about stagnating growth in China in 2023. Clearly, that's going to be a little different, but it seems hard to understand exactly how it's going to play out and the difference between the first half of the year and the second half of the year.
Yeah, by stagnating growth, you mean growth at the same level as in 2022?
Yeah, I think that's where we might have been 2 months ago, but revisions on that now, at least from my perspective. But tell me what you think.
Yeah, no, we have had a negative view. It was largely driven by zero COVID and the cost of zero COVID in 2022, but obviously that has changed dramatically. So we've made some very substantial changes to our forecast as well. We're now looking for 2.6%. After 2.6% in 2022, we have 5.2% growth for China this year on an annual average basis. If you look through the year, fourth quarter to fourth quarter, we're a little over 7%. And this is really driven by the rebound post the kind of peak in cases that we've probably seen now. Our China economists think the peak in cases nationwide has occurred. It's obviously hard to know for sure because the government isn't really publishing that information anymore, but we're inferring it. And we're now expecting, a kind of V-shaped recovery, as we've seen in many other economies that have been shut down because of COVID. Our team estimates that pre-reopening, the level of GDP was 4 to 5% below where it would have been ex-COVID restrictions and ex-COVID caution. So that gives you maybe a sense of the theoretical potential for above trend growth that you could see if you get really past this. You probably won't recover all of it, but if you did recover all of it, then that 7% plus number for Q4 to Q4 might actually end up being conservative. I mean, it's quite possible that we'll see some very strong growth numbers for a period of time. Probably not really in Q1, just given how quarterly average GDP numbers work. We're really talking probably more Q2 as far as the quarterly numbers are concerned, but you could see a very sharp acceleration. None of this says that the longer term economic issues and challenges that China is facing have gone away. Demographics are still a challenge. The property market is still a challenge. I expect property activity to come down very substantially in coming decades. That's going to be a long-lasting drag. But notwithstanding that, I think in the short term we can see a pretty strong recovery.
So that's really interesting. So one, you see peak cases already having happened or already past that point, with all the caveats that we have to apply to that assessment, given inability to know exactly. And two, a really strong rebound story in China this year, understanding that there are still serious structural issues at play that will weigh on their growth over the medium and long term. We do a lot of work on this at the Council through our China Pathfinder project. We'll share that here. Megan, you wrote about this recently in the FT. You wrote about the 3Ds: debt, disease, and drought. Disease, of course, in a very different place, as Jan was talking about, and as we see with the change in zero COVID. But I'm wondering a status update from you on debt, on drought, on these longer term issues that will weigh on Chinese growth in the year and years ahead.
Sure. So I like Jan, also expect China to see growth accelerate this year. I think it might take longer, though. I actually don't think China has seen its peak in cases necessarily, just because the Lunar New Year is about to start. So, people from tier 1 cities are going to go to tier 3 cities, which haven't had much COVID. You'll get a new wave then. And then upon return, you could, after the Lunar New Year, you could get another wave in tier 1 cities. We don't have much official data. I teach a course at Schwarzman College, Tsinghua University, so it's anecdata. But if, the students are any indication, COVID's just been absolutely ripping through Beijing, Shanghai, the tier 1 cities. But I think, China's still very much still waking up from its COVID slumber. And so, I think we could see supply chain disruptions as a result of that in the short term. But B, I also think it will take a while for the data to turn around. I mean, PMI data for China is near record lows. Korean exports to China were down 27%. So the data is looking pretty bad. It should improve from there. I think China is continuing to have to balance its short-term economic objectives with its longer-term objectives, like common prosperity, taking moral hazard out of the real estate market, climate change. And over the past year, I think China has prioritized some of those longer-term issues. This year, it's very clear that they're going to prioritize the short-term economic growth issue. And so I expect that fiscal and monetary stimulus will be forthcoming. A big piece of the success of that will be a boost in consumer confidence in China, which has been incredibly low. Now, that was partly thanks to the real estate sector, but it was also partly thanks to zero COVID and the uncertainty about whether you would be locked down and for how long. Now, that second issue has been removed. And so Chinese confidence can turn on a dime, and I expect it will rebound pretty significantly. And so I think that should give fiscal policy in particular something to work with. It won't be pushing on a string quite as much. But like Jan, I worry about the real estate sector. The Chinese Communist Party has announced a bunch of stimulus measures. I think that they probably can manage defaults in the real estate sector, but because it's a centrally planned economy. But if they can, if you get cascading defaults, that would be a massive drag on growth. I think they are committed to this shift in climate change. I mentioned drought just because China's running out of water, which is important in sustaining human life, but also industry. And so I do think that the Communist Party is serious about climate change, but for this year, economic growth is going to be the real priority.
So I have two more questions I want to get to, and then we have a lot of audience questions. And if others want to submit, now's the chance to use the Q&A function. But one on Japan and then one on global macro. So Megan, I'll start with you on Japan. You wrote about this recently. I'm trying to think how to phrase this. What happened in December at the Bank of Japan? How should we interpret it? Is it the signal of the end of yield curve control, or is it really, as Governor Kuroda said, about market functioning? And what do we expect when the new governor comes in early in 2023?
Yeah, so Kuroda surprised us all by adjusting the band for yield curve control and the 10-year yield. The yield curve was kinked, so he said he wanted to address that. Unfortunately, the yield curve is still kinked even after this move. Kuroda went out of his way to say that he was just restoring market functioning and making it so that yield curve control was more sustainable. I don't think that's probably true. I think that is the first step towards backing out of yield curve control. We have some examples of this being done before. The US, the Fed did it in the 1950s. They had yield curve control. They backed out of it. And more recently, the RBA in Australia backed out of yield curve control. It never goes smoothly, so I'll start with that, but it can be done. Yield curve control isn't quite the Hotel California. You can check out and leave. But it's just not easy. And so I think this was the first step. Inflation has accelerated in Japan, surprisingly, I guess, given that they've had no inflation for so long, but unsurprisingly, given that we've had high inflation everywhere else. I would have waited until after the spring wage negotiations to make sure that they're getting the kind of sticky inflation that they want, to know that inflation is really sustainable. But the timing of this was clearly pushed by Kuroda's retirement in April. I think he felt that he has some credibility built up, so it will go more smoothly if he started the process of backing out of yield curve control than if he didn't and a new guy had to come in and do it with no credibility at all. And so I do think this is the first step towards a tightening. I don't think it will go smoothly. I think, though, that the biggest loser in all of this is the biggest holder of JGBs, and that's the Bank of Japan itself. So that's not such a huge deal. Japanese banks themselves aren't particularly exposed. They hold JGBs for capital ratio requirements, but aren't massively over leveraged. And so I don't think it needs to be a massive financial event, but it's hard to know because the Bank of Japan has been such a big buyer for so long that the market's totally distorted. One concern is that you'll have a huge sucking of Japanese capital back into Japan, as you can actually earn on yields in JGBs, and that is possible. I think there are two mitigating factors. One is that Japanese capital has already been leaving the rest of the world, and particularly the US Treasury market. That's partly because it's just gotten much more expensive to hedge the currency. And so we've already seen Japanese capital flowing home a bit. And secondly, based on this hedging of the currency, I think banks will be reticent to have to mark to market and take losses. So they might not bring capital back as quickly as some people fear. So I think it can be managed, but it will probably be rocky.
Megan, thank you. And Jan, I love your take on Japan. And I also want to ask about liquid debt before we get to audience questions. The World Bank came out with a pretty dire outlook yesterday, I think different in tone and forecast than what we're talking about here on many fronts. Liquid debt was front and center, given their mandate, talking about over 60% of LICs at risk of debt distress in the year ahead. I wonder if you see it that way. And I also thought it was interesting, Governor of the RBI talking about a potential wave of debt defaults in Southeast Asia. Those two things combined, are you pricing that into a base case forecast, a tail risk forecast? How do you see liquid debt issues from your perspective?
So first of all, in Japan, our expectation would be further tweaks, but base case is not for an exit from yield curve control. I also think the pressure on the Bank of Japan, might recede somewhat if we're getting to the sort of last stages of Fed rate hikes, and I think that's going to make it somewhat easier. Obviously the increase in inflation in Japan has been lagging everybody else, so that still has probably some ways to run. But I do think that the pressure is going to be smaller than it was in 2022. And then in terms of low income countries and debt, I would say of course, it's been a very difficult environment for low-income countries. I mean, relative to that environment, given the 425 basis points and counting of Fed hikes, it's been actually pretty remarkable how well many low-income countries have held up. Are they going to be defaults? I mean, that's certainly a risk. That's often the after effect of a more difficult environment, but it's not something that we have as a sort of central part of our global economic view in 2023. If I just, since you mentioned the World Bank forecast, they are obviously very focused specifically on low-income countries. They also had a relatively negative view on the global growth picture for 2023. It's not really away from the consensus. Consensus forecast is also about 1.7% or so. Our own view is a little bit more optimistic, as I discussed, because of some upside for the major countries. But I would say the international organizations obviously have been catching down to the consensus view over the last couple of quarters.
Yeah, and it's a good point. We'll see the WEO update, I think, right ahead of Davos from the IMF, and we'll see how that fits into consensus or not and what revisions they have. Megan, did you want to jump in?
Yeah, I'd say the outlook for emerging markets looks a bit better this year, largely because the Fed is likely to step back from aggressive rate hikes. And so that should lead to a further weakening of the US dollar and also a fall in US treasuries. So that should make things a bit easier for emerging markets that are trying to service their debt in local currency if it's denominated in dollars, and also that invoice their imports in US dollars. That being said, I think the IMF has said about 2/3 of low-income countries are under debt distress. So I do think that there will be a number of defaults. On the bright side for the major economies, the blowback from that shouldn't be huge. These countries account for a very small percentage of overall global GDP, so the impact on global growth won't be massive. But I am worried that the IMF and World Bank don't have the best tools to address this. The common framework has largely been a failure, I think, in that you've only had one negotiation of a debt restructuring. It only applies to low-income countries. I think a number of middle-income countries could end up being dragged into this as well. So the tools aren't ideal.
I agree with you there. And if there is a wave or even a few debt defaults in 2023, I think we're going to look back at the failure of the common framework as just a huge missed opportunity over the past 2 years when there was time to get this right. We do a lot of research on this through our Bretton Woods 2.0 project. We'll share that with everyone, but I'm glad you raised it. So Jan, I have a question in the chat for you, and it goes back to what you said in the first answer about the Fed and long and variable lags on monetary policy, because I think you made the point in your opening that a lot of what the Fed has done is already been felt in the system, which I think would surprise some who think of this sort of longer transmission mechanism of monetary policy and feel like everything the Fed has done over the past few months will play out over the course of 2023. Could you just take us inside the thinking a little bit of why you feel that most of it has already been baked in?
Yeah, sure. So the place to start is probably Milton Friedman, who said that the impact of monetary policy occurs with long and variable lags. But if you look at what he actually said, you look at the whole passage, what he was talking about was the lag between monetary tightening and the peak impact on the level of GDP. That's a big difference. There's a big difference between the level and the growth rate. I mean, what he said is quite consistent with our findings, and frankly, the findings in the academic literature, that the lag between monetary tightening and the peak impact on the growth rate of GDP is actually pretty short. About 2 quarters is what most of the studies find. And that is effectively what we're building in. I mean, specifically, we focus on the lag between the financial conditions tightening and the peak impact on growth. Financial conditions tightened, of course, alongside the big revisions in people's expectations and the Fed signaling for where the funds rate was going to go. And the biggest revisions there really occurred in the first half of 2022. and 22. There have been some additional revisions since, but they haven't been as powerful. And so that's what we're taking our cue from. I think a good example, if you just want to make it a little bit more tangible, is to look at housing. So residential investment contracted at a 27% annual rate in real terms in the third quarter. And fourth quarter, our guess is something similar when those numbers come out. And then as we go through 2023, I think we'll probably see further declines in residential investment, but not at a 27% annual pace, maybe at a 10% annual pace or something like that. So that's sort of the point. And this is a very important part of the monetary transmission mechanism. Fed tightening, higher mortgage rates, a hit to housing activity, and the biggest effects there, at least, I think, are probably behind us at this point. Other parts of the transmission mechanism have somewhat longer lags, but when we average it out, 2 quarters seems to be a reasonable sort of average.
Thanks, Jan. And I'm very glad we got into the nuance of Milton Friedman because that quote is obviously thrown around all the time. And as you say, arguably misinterpreted. So thanks for explaining it. Thanks for explaining your thinking. Megan, a question for you on the Fed. You said in your opening, markets were mispricing the Fed. And the question here is about why don't markets believe Chair Powell and what he says? And is this a bigger Fed credibility issue at stake in 2023?
Yeah, so I think it is partly a Fed credibility issue, and that the Fed got the sustainability of accelerated inflation wrong and had to pivot once. And so maybe they'll have to do it again. I think it's also markets just pricing in what they want to see, which is rate cuts, right? That's good for markets generally, particularly equity markets. And so I think it is, to some degree, markets trying to lead the Fed. And here I think the Fed is just going to have to be willing to surprise the markets at every meeting where they reiterate what their view is. Even though the Fed doesn't like surprising markets and the markets don't like being surprised, I think to avoid being led by the markets, which is a very inefficient way of conducting monetary policy, that is what the Fed is going to have to do. I'd also just want to highlight this point on financial conditions because they have loosened more recently. And so if I'm right and the markets are mispricing the Fed, they're going to have to tighten. But what I haven't mentioned is that if I'm wrong, and actually the Fed ends up having to cut, then financial conditions will be loose if we see inflation persistently high. So more along my forecast than Jan's, then the Fed might have to re-up rate hikes later. And so we could end up then seeing a tightening of financial conditions in the back end of next year. I think that's a risk most people aren't really considering. But either way, I think financial conditions are likely to tighten from here.
Okay, that's important flip side of that, the financial condition situation towards the tail end of the year. Jan, there's a question about energy exporters, oil exporters in particular. Does the China reopening story change the outlook for oil exporters and the mix of that versus a potential recession or borderline recession in the US and Eurozone outlook for oil exporting countries?
Well, it should help them, obviously, all else equal. And it is a reason why oil prices in our forecast rise in 2023. All else isn't equal because we've also gotten this very warm winter so far, which is weighing on the demand for heating oil. And so far, these things have roughly offset. But no, China reopening is going to mean more domestic air travel, for example. That's going to boost oil demand, and I think is a reason for expecting a rebound there. And this plays out over time, as our oil strategists have been saying, over and over again. I've heard it many times. Oil is not an anticipatory asset, unlike equities, let's say. So the impact really only occurs when you see the impact on demand. Right now, economic activity in China is very weak, as Megan was saying. We're starting to see some rebound, but it's really only beginning. So this is really something that should play out Q2 or sometime like that. And of course, if it does play out, that will also help oil exporting countries.
Right. That makes sense. And now a question we have on war in Ukraine. And the question is whether the biggest global economic shocks from the war have already been felt, or if the war drags on throughout the course of 2023, are there other ripple effects that have not really emerged so far that we will see in energy markets, food, otherwise? Megan, let me start with you, and then I'll go to Jan.
Yeah, so to answer that question, you sort of need to know what the choreography of this war is going to be over the course of this year, and that's impossible to forecast. But I'll give you one example of what I mean. If we were to see the use of a tactical nuclear weapon in Ukraine that could wipe out all of Ukraine's agriculture, for example. So that would be a new shock that isn't already priced in. So that's not my base case scenario for what it's worth, but it's also not impossible at this point. So if we just got sort of a continuation of what we've had so far, a lot of the shifts in pricing and inflation may have happened, but I don't think we can expect it to be exactly as it was last year. So I do think there will be new shocks.
Jan, do you agree?
I mean, I think the biggest shock has occurred, yes. Barring the tail scenarios of much more substantial escalation, and maybe it's a fatter tail than we would like, but it is more of a tail scenario. And yeah, I think a lot of the adjustments from a global economy perspective have occurred at this point. And you can see it in the commodity markets, I think, most clearly. So I would expect less of an impact in my base case this year.
Okay, so this is an academic question, and it's one that I know consumes a lot of debate time at the IMF. How do each of you define a global economic recession? Because I don't think there is a universally agreed to definition on that. Megan, I'll start with you.
Yeah, there is no definition of recession globally or within economies. My favorite definition is the NBERs, which is the group that kind of declares recessions in the US, which is effectively, we have a different methodology every time. But what they do is take a broad-based view of macro indicators to determine whether it's a recession or not. So the kind of quick and dirty definition of 2 quarters of contraction, I don't really buy. I think it needs to be more broadly based. You need to see a deterioration in the labor market generally. That would be a certain input that I would expect to see.
And obviously a US recession, 2 quarters, as we think about it, contraction versus global recession would still be positive GDP growth, right, Jan? But just below a certain baseline, depending on what we think that baseline should be.
Yeah, I don't have a global recession definition. In the US, we, as basically all other forecasters, use the NBER definition. And I think I would agree that it's a sensible approach. In other economies, we do tend to use 2 negative quarters just because there isn't really an alternative. There's no European NBER equivalent. So that tends to be the choice, but it's far from perfect. And then when you go to the global economy, of course, you would have a different cutoff somewhere in positive territory, probably looking at annual average numbers, and then whether it's 1.5% or whatever the number is. But in the US, I think NBER makes the most sense.
Yeah, I do think that we economists uniquely care about the difference between a recession or not a recession. For most people, really low growth or contraction, it all feels the same.
And of course, as we saw...
One thing I would say on that, though, in the US historically, there has been a very clear dividing line between expansion and recession. I mean, expansion is unemployment rate going down or sideways. Recession is unemployment rate going up sharply, right? You generally have not seen recessions with an unemployment rate increase of less than about 2 percentage points. So it really have been 2 quite different states. This could be different. This is another way in which the cycle could be different. So it's quite conceivable, I think, that we do see a recession this year, contrary to my forecast, but that it's something more like a 1 percentage point increase in the unemployment rate. You have seen some of these types of cycles in other advanced economies where the economy was contracting, at least based on a number of indicators, but the unemployment rate was only sort of edging higher and not shooting higher the same way that you've seen traditionally in US recessions.
So one more audience question, then I'll ask you a final because we just have 5 minutes left. The audience question, we got a few on this. Are we past strong dollar, peak dollar? This was, of course, a big theme at the IMF meetings a few months ago. But if the Fed does what they say they're going to do and still raise, even at a slower pace, and end up at 5.25, does that ease dollar pressures around the world that we saw weighing so heavily on a range of emerging markets, or are we past that right now? Megan, let me start with you.
So I think we have seen peak dollar strength already, and that the dollar should weaken here, even if the Fed is more hawkish than the markets are pricing in. And that's partly off the back of sort of monetary policy divergence, right? So the ECB has become way more hawkish than the Fed has, and Europe is in a different place in terms of its cycle. Anyhow, the UK as well, I think, has more rate hikes in it. So even if markets have mispriced the Fed and have to reprice, I think that could weaken or could abate the weakening of the dollar rather than see the dollar strengthen from here.
Jan?
I think we're past peak dollar probably. And, I think the reason is that we are likely to see continued, declining inflation in the US. And I think the Fed's going to tighten, but not too far from market pricing. And I think in that kind of environment, with the ECB still doing more, I would expect some dollar retracement lower.
Okay, so final question now for you both, and this is what we've asked in past years, so hopefully you're prepared, which is, what are we not talking about? What is the black swan event, the tail risk event that could come in and really shock the global economy? And I had the team look up what you both said last year, and it's you did pretty well. So Jan, you talked about new variants outside of Omicron continuing and how COVID would continue to play out on the economy. I think we certainly saw that in China in 2022. And Megan, you talked about over leverage, corporate and sovereign, and how that was going to continue to affect various economies, both in EMs and low-income countries. And maybe we didn't see all the ripple effects of that in 2022, but as we talked about, we may see more in 23. So I think everyone gets a high mark for their predictions last year. And Jan, I'll start with you. Your tail risk scenario, what we're not talking about for 2023 that we should think about.
Well, we did talk about some of the tail risks. I think, obviously the debt ceiling, I think, is more of a tail risk. The escalation in Ukraine was more of a tail risk if things really get significantly worse in terms of weapons of mass destruction, etc. So I would put those on the list of tail risks. Otherwise, for me, the biggest risk, honestly, it's not as much of a tail risk, but it's very much part of the central outlook. And we talked about this about a year ago. Narrow path to a soft landing. Narrow path to a soft landing means you need below trend growth in order to rebalance the economy and rebalance the labor market. If you get a premature acceleration in growth to an above trend pace with job openings still at 10.5 million, then that's not good. That's not actually what we want. At the same time, if the economy slows too much and you start seeing negative multiplier effects in the labor market, then and the economy were to spiral into more of a recessionary situation, that's bad too. So staying on that path is going to be hard. It's going to be difficult for policymakers to calibrate the amount of restraint to get that done. And so to me, that's the central risk, but there are obviously some more exogenous tail risks that we have already discussed.
Okay, thank you so much. Megan, over to you.
Yeah, so I guess my biggest worry, or what I don't think enough people are looking at, is market blowups next year as the tide of liquidity has gone out, the era of cheap money is over, and we have no sense of where they might emerge. But I think private equity is a concern, given that private equity took much smaller losses, paper losses last year than public markets. So maybe their investment strategies are superior, or maybe there are more losses to come out in the wash. And then corporate debt, U.S. corporate debt, I'm worried about a third of our corporate debt in the U.S. is BBB rated. So that's the last rung of investment grade. And so if there are a series of downgrades, you could see bond funds, for example, with forced selling of corporate debt. So you could get a sort of LDI style blow up. And with the UK LDI blow up, the Bank of England could step in and buy up treasuries, and that restored market functioning. But the Fed's not going to step in and buy junk bonds. They just won't. And so there's no obvious fix for that sort of thing. So you could see severe market dislocations with no clear remedy, and that could cause a financial crisis.
Okay, so we have the tape. We can review it next year if you're both willing to come back and do this. I'm so grateful for your time. We had such an audience response, so many questions we couldn't get to in an hour. We covered a lot. We clarified Milton Friedman. We compared Bank of Japan and Hotel California. So there's much more we need to talk about on the global economic front. It's just a start. But I think going back to where we started, there's so much uncertainty this year. And we just have to look at the range of forecasts and the way they're changing to understand we all have to be nimble, humble, and know this will be another year of surprise, but hopefully growth, hopefully employment, and hopefully better economic prospects, both in the US and around the world. So Jan, Megan, thank you. Thank you everyone for joining us this morning. Please continue to follow the Atlantic Council Geoeconomics Center's content throughout the year. We wish everyone a great rest of the day.
Thanks.
Thank you.